Hi, my name is Mary Pel Opariado. I'm your course teacher for corporate financial analysis. In this session, we'll be discussing cash flow from the three main activities of businesses: operating activities, investing activities, and financing activities. Now, by the end of this session, you should be able to discuss the various activities that relate to cash flows under operations, under investment, and also under financing activities of a company. So we'll examine into details the cash flow statement that relates to operating activities, investing activities, and financing activities. And we'll also discuss other important matters relating to cash flows of companies. According to IAS 7, those cash flows that arise from the principal revenue producing activities of an entity are what we refer to as operating activities. So, for example, if you have cash flows that arise from, let's say, you're a book publishing company, so those cash flows that arise from you selling goods or books or rendering services relating to publications, any cash receipts from those sales or from those activities are known as your cash flow from operating activities. Also, receipts from royalties, fees and commissions and other revenues would also be part of your cash flow from operating activities, as well as cash payments that you make to your suppliers for goods and services, and also cash payments you make to or on behalf of your employees will be considered cash flows from operating activities. So basically, it's all the inflows or outflows that arise from the primary purpose of the business or from the core mandate or revenue producing activities of the entity. Also, according to IAS 7, expenditures that result in a recognized asset. By asset, you know any item from which economic benefit is expected to flow into the company, and therefore it's being recorded in the statement of financial position or the balance sheet, is eligible to be classified as an investing activity. So it includes any purchase of non-current assets such as property, plant and equipment, machinery, or any intangibles or other long-term assets. Also, cash receipts from the sale of these properties, plants, equipment, intangibles, and other long-term assets are also classified as investing activities. Also, if there are cash advances or loans that are made to other parties or businesses, we would consider all these investing activities. So you should take note, anything or any asset that is recognized as an asset, any item that is recognized as an asset in the statements of financial position on the balance sheet or expenditures can be recognized or should be classified as investing activities. When it comes to financing activities, there are those activities that results in changes in the size and composition of owner's capital and borrowings of that enterprise. In other words, those activities that has effect on the capital structure of the firm in terms of equity or debt are what we refer to as financing activities. So they include cash repayments of amounts that have been borrowed or cash proceeds that arise from the issue of shares or other equity instruments, and also cash payments to owners to acquire the in part or whole the entity shares are all referred to as cash flows from financing activities. So anything that affects either equity or anything that has to do with equity and debt or affects the capital structure of the firm are activities that we refer to as financing activities. And note, they result in changes in the composition or the size of the capital structure of the firm. So other transactions that we will take note is the foreign exchange cash flows. So now any cash flow that arise from transactions with foreign currency are supposed to be recorded as per IAS 21. However, the amount that has to be reported should be done by applying the exchange rate at the date of the cash flow statement. You should note that unrealized gains and losses that arise from changes in foreign currency exchange rates are not cash flows In other words, they do not result in cash leaving the business or cash flowing into the business. They are just gains and losses that are unrealized, but they have no cash implications. Therefore, they are not cash flows. So let's take note. Also, extraordinary items that are any cash flow that relates to any items that are not normal to the business should be classified into one of the three activities to the extent by which these items relate to them, or better still, they should be separately disclosed in the statement of cash flow. So for example, if there are bad debts you recover bad debts, or there are claims you receive claims from an insurance company. Let's say there was a theft of an item or an asset that has been insured, and you receive claims from the insurance company. Since it was a non-current asset, you would classify it in that particular claim from the insurance company has an investing activity. Also, bad debt has to do with the core operations of the firm or the revenue generating activities of the firm. Therefore, if you recover a debt you already wrote off, then you would want to classify this inflow as an operating cash flow activity. Also, if there are lawsuits, you win any lawsuit or you have to pay for lawsuits, you, as much as possible, you identify the extent to which that lawsuit relates to any of the activities, whether it's operating, investing, or financing, and then you disclose it in that regard. Also, when it comes to interest and dividends, cash flows that arise from interest and dividends received and paid should be disclosed separately, and the treatment depends on the nature of the enterprise. Okay. So interest and dividends received would be treated as cash flow from investing activities, because when you invest, that's when you get interest, that's when you receive interest and dividends. However, when you pay dividends on your equity share capital or preference share capital, then you would classify that as an outflow from financing activities. Taxes on income. Now, cash flow that relates to taxes on income should be disclosed separately and classified as cash flow from operating activities, unless in cases where they can be specifically or particularly identified with an investing activity or a financing activity. So let's say you made an investment and earned returns and you have to pay taxes on that returns you made, then you can classify that tax on income as an investing activity. Otherwise, all other taxes on income are deemed to be from operating activities. Also, when tax cash flows are allocated for over more than one class of activity, the total amount of taxes paid should be disclosed in the statement. Investment in subsidiaries, associates, and joint ventures. Now, like we said, these kind of investments should be reported in the cash flow statement as an investment activity, and therefore any dividends that you receive from any investment in subsidiaries or associates or joint ventures should also be reported as cash flows from investing activity. Acquisition and disposal of subsidiaries and other business units. So the aggregate cash flow that arises from acquisitions or disposal of subsidiaries or other business units should be presented separately and classified as investing activities as well. Then there are also non-cash transactions. So investing and financing activities that do not require the use of cash or cash equivalents should be excluded from cash flow statements. Like we mentioned earlier, the cash flow statement only has to do with items or transactions that result in cash leaving the business or cash coming into the business. So once that transaction or item does not result in any cash inflow or outflow, those items or those transactions are considered non-cash transactions. They should be disclosed in the financial statements in the way that provides all relevant information about the investing or financing activities. So, for example, depreciation. When you buy a fixed asset, you'd want to know and account for depreciation, because the asset will have to wear out and you'd have to set some amount of money aside periodically. However, depreciation is just amount that is set aside, but it's not necessarily cash being spent. Okay. And also, when you have to convert debt into equity, it does not include cash, and it's also a non-cash transaction. So in this session, we discuss into details the various operating, financing, and investment activities, and how other items such as non-cash transactions, foreign exchange transactions, interest and dividends, non-cash items should be treated. Thank you.